The truth is, beating the market isn't as easy as it sounds, and it's not about being the smartest in the room. In fact, most investors get it wrong without even realizing it. In this video, I'm going to share 8 investment truths that will completely change how you think about the market. By the end, you'll be armed with a whole new strategy for making smarter, less stressful investment decisions. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. These truths aren't new. They've been around for as long as investing has existed. The same questions come up over and over again, and investors still make the same mistakes. Yet, these timeless lessons have withstood the test of time because they cut through the noise and get to the heart of successful investing. So, let's dive into the first one. Firstly, you're not that smart relative to the market. Sure, you might be really sharp, but that's not enough to outsmart the whole system. If you're aiming to beat the market, you've got to be quicker and sharper than everyone else trying to do the same. The thing is, the market as a whole is pretty much smarter than any one individual. So even if you're brilliant, the collective intelligence of the market is tough to beat. Crashes and bubbles are part of the game. They've been a consistent feature of the market, and often, the stories that surround them only make things worse. While each crash or bubble has its own unique narrative, some patterns never change. After a crash, markets typically bounce back, and the returns are more often positive than negative. But bubbles? They're driven by hype, and once the excitement fades, they usually end in disappointment for those who got caught up in the frenzy. Even though the details differ, these cycles continue to follow the same general playbook. The market is forward-looking. The market is always looking ahead, constantly trying to predict what's coming next. Everyone involved is racing to be the first to share new information, hoping to get ahead of the game. But here's the catch. No one has all the information all the time. Even if you think you've found a nugget of info that gives you an advantage, chances are it's already priced in. The market is quick to digest and reflect whatever news is out there, so the edge you think you have might not be as sharp as you think. Market forecasts aren't all that helpful. In fact, they're usually more wrong than right, and they tend to mess with your mindset as an investor. Focusing too much on these predictions, and even worse, making decisions based on them, won't improve your strategy. In fact, it's more likely to just create unnecessary stress and anxiety. It's better to stick to your plan and not get caught up in the noise. Time in the market beats timing the market. Trying to time the market often leads to missed opportunities. Many investors make the mistake of buying and selling based on short-term market movements, which usually results in poor performance. A disciplined, long-term strategy, like buying and holding quality assets through market ups and downs, is far more effective. After factoring in trading costs, taxes, and emotional decisions, trying to time the market typically erodes your returns. The real advantage comes from staying invested, letting your assets grow, and avoiding the urge to react to every market fluctuation. Most funds don't actually beat the market. We see from fund flows that investors tend to pour money into funds that have performed well recently, hoping that success will continue. But here's the catch. Funds that have done well in the past aren't any more likely to keep performing well in the future. In fact, some studies show that funds that have been successful lately are actually more likely to underperform going forward. The reality is, the majority of actively managed funds fail to beat the market over the long term. Expected economic growth and stock returns are not directly linked. This is a common misconception, especially among newer investors. Many believe that if they invest in the fastest-growing companies, sectors, or countries, their investments will naturally outperform. The truth is, it's much more complex than that. Economic growth is already reflected in stock prices, so just betting on growth doesn't guarantee higher returns. What matters more is how that growth compares to expectations and how it impacts the underlying risks of the investment. And finally, expected growth is already built into current prices. If the growth unfolds as anticipated, the returns will generally match the asset's risk level. However, if the growth turns out to be better than expected, you might see a pleasant surprise in returns. On the flip side, if growth falls short, the returns can disappoint. Essentially, the relationship between expected growth and actual returns can feel pretty unpredictable. So now that you've got these 8 investment truths under your belt, it's time to put them into action. Remember, it's not about trying to outsmart the market. It's about being strategic, disciplined, and sticking to a plan that works over time.